Hey, how's everyone doing? Welcome to the Strategy Room on this Sunday version, July 7th, 2025. I thank everybody for being on here with me. I know this is kind of an unusual time. I was actually coming off vacation this week, so I was not able to do the usual time on Saturday night at 8 o'clock, but I was able to get in here. And we probably won't be doing the normal 2 hour show today. I think we'll probably just go. We'll see how long we go today. Maybe an hour, a little over an hour. But we will get into all of the things that were going on. Obviously, some big stories that came out this week. The jobs report was a barn burner. Obviously, politically, you had the big beautiful bill that passed, and we're going to take a look at a couple of things there, tax wise. Like, what does that potentially mean for you and your business on a tax basis? So we'll talk about that a little bit. We're going to talk about tariffs a little bit. What's going on? Obviously, there was the big tariff agreement with Vietnam that happened this week, but there's a bigger deadline that is looming on July 9th. So we're gonna talk about that here a little bit. I also got a bunch of AI, a bunch of crypto stablecoin related news from things that came out over this last week. And as usual, I'll go over the economic indicators. I'm going to talk about the episodes that I had come out this last week. Obviously, if you did not see the interview with former Fed Governor Dr. Thomas Honig, that was a huge one. People are really loving that, getting a massive amount of response on that one right out of the gate, as I thought that I would, but glad it was very glad to see that going on. So okay. Let's jump into it as we usually do. I like to just show everybody the U.S. debt clock screen here. Now, I do want to say they just did a refresh on this, which I actually think was pretty cool. They actually changed a bunch of things up here. Like, for example, they have largest budget items right down here below kind of the main clock on the left-hand side. And we have, Medicare, Medicaid, Social Security for defense spending, for war, and then interest on the debt, which I think is great because that helps to point out. So in other words, we're spending over $1 trillion right now just on the interest to service the national debt. So that, again, defense budget, $911 billion. Inching its way up to $1 trillion defense budget. Obviously, Social Security, $1.5 trillion, Medicare, Medicaid, $1.6 trillion. And then it goes into kind of unfunded, total U.S. debt, total U.S. interest paid, credit card debt per holder, $8,233 per holder on the U.S. credit card debt of $1.3 trillion. And then we got a little box that popped up there. But then it goes into, money creation here. Treasury dollars, $1.6 trillion. Money supply, $22 trillion. Currency and credit derivatives now, $730 trillion. I mean, you can't even conceive this number in your mind. Now, obviously, I just did a report this last week on derivatives activities. I'll talk about that a little bit later. But yeah, just a lot of great things on this chart here. I mean, there's so many things here at the bottom here. It's got kind of hidden wealth, asset-backed dollars, talks about precious metals, mineral reserves, real estate, $75 trillion in real estate, $24 trillion in land, $51 trillion stock market, recaptured assets, total hidden value, $174 trillion, wealth per citizen, 510,000. Fed fiat dollar, the dollar's loss in value, 1913 to now, 96.23% loss in value. U.S. Treasury, the dividend dollar gain in value in 10 years is up 34.44%. So again, just a lot of little interesting nuggets in this. I love the refresh and the upgrade to this. Which is really nice. But again, just going back to the main numbers here at the top for just a second, if we can. Again, we went over $37 trillion in national debt. Our U.S. Federal budget deficit on an annual basis is still a little over $2 trillion. Doge clock continues to run at $545 billion, savings per taxpayer of $4,859. Our debt to GDP continues to remain at 123%. You could see that I just want to point out that the U.S. federal debt to GDP ratio, you could see 1960, it was at 52%. And then 1980, it had dropped down to 34%. But then by 2000, it had gone back up to 57%. And then now we're up to 123%. At a very dangerously high level, being at 123%, obviously something that needs to come dramatically down. Now, you might say, why in 1960 was it 52%? Well, that's a great question. And the answer would be World War II. So we ran a major deficit in, paying for World War II, but then we spent a lot of time the government spent a lot of time bringing that debt down. And obviously we had an economic boom. After all the baby boomers came back, we really saw the golden years of Ford and GM and Chrysler, and a lot of America was just an absolute manufacturing powerhouse in those days. So we had a lot of surplus money, and our GDP was growing at a much higher rate back then. So we were able to pay a lot of that debt back down. And it still took a long time. I mean, 1960, that's 15 years after World War II ended. But we were still bringing it down. And again, by 1980, you're talking about 35 years after World War II, we had brought it all the way back down to a very manageable, very reasonable 34%. But then you can see here over the last 45 years how we've gone from 34% up to 123%, and we're just on an absolutely unsustainable path. And again, and we'll get into more of that here in just a few minutes. But so let's jump into. So Trump passes the big, beautiful bill this week, right? So banks say Trump's big, beautiful bill could boost the U.S. economy despite deficit concerns. So the American Bankers Association said it strongly supports many provisions within the bill. The legislation is almost unquestionably good for the U.S. economy over the next few years compared with passing nothing, a Nomura economist said. So U.S. President Donald Trump's Big Beautiful Bill, or officially the One Big Beautiful Bill Act, is a controversial piece of legislation, but some banks are in favor of it, saying it's the shot in the arm the economy needs. I would say, yeah, it was advanced and narrow. The bill, which is characterized by sweeping tax reforms and targeted incentives and is forecast to add to the federal deficit, has triggered warnings from credit agencies and drawn criticism. But some banks say that the bill could boost the U.S. economy. Unquestionably good. So in a letter published Sunday, the American Bankers Association said it strongly supports many provisions within the bill for the much needed tax relief they offer. I think the OBBB would almost unquestionably be good for the U.S. economy over the next couple of years compared to passing nothing, said David Seith, Nomura's chief economist for developed markets, given that taxes will rise substantially next year following the expiration of many provisions under Trump's 2017 tax bill. Yes, I would absolutely agree with that sentiment. I think that is absolutely true. I think this was again, from a political perspective, the Republicans, they had to do something, right? They had to do something. They had to get something passed. They couldn't obviously sit there and do nothing. From a tax perspective, this had to get passed because otherwise you were going to see taxes, jump up as all of the tax cuts and everything that were made from that 2017 bill were going to expire and they were going to go away, which was going to cause taxes to massively increase. So again, something had to be done there. Is this bill perfect? No, absolutely not. Obviously said a lot of critics say that, oh, well, this is going to boost, government deficits over the next 3-4 years. But I would say this, here's the problem with those estimates, though. They do not account for growth. Nothing accounts for growth. One of the things I've talked about on the live stream here, and one of the things I talked about last week, was the tariff income that is coming in the door. We're close to almost in June. We got up to $28 billion in tariff revenue. The tariff revenue is going to come in and is going to play a bit, it's going to reshape a lot of this stuff. It's going to lead to a resurgence in American manufacturing. Are we going to go back to what we were in the 50s and 60s and 70s? Maybe not. But are we going to be a lot better than I think we have been in the last 30 years? I would say absolutely yes. So a lot of, and again, they're not looking at the growth. Again, Trump has done a great job. He's got literally trillions of dollars that are going to be coming in from all these companies that are going to be making things in America. And I've been showing for the last month or so. I've been giving examples of companies that are, GM's bringing a bunch of jobs back. A whole bunch of companies, but building data centers, are going to build microchips. And these are good jobs. These are not fast food jobs. These are good, high paying, sustainable jobs. And that's the piece that's really not considered in this. There is another side effect, or not another side effect, but there's another side piece to this. And that is when the fiscal year end of the government comes up on September 30th, the Republican controlled Congress is going to be able to make cuts to a lot of things in the appropriations process. That's where it gets a little tricky, because again, it's like a leap of faith. You have to have faith that hopefully they will get a little bit more stern in the potential to cut stuff during the appropriations process, which they very well could. They could get a lot more aggressive in cutting things in the appropriation process, which again could nullify the potential side effects of what we were just looking at here. Now, again, I think that is it going to be easy to get this back to a balanced budget, to cut $2 trillion in spending? No, I don't think so. At least, we were hoping that, Doge was going to come in and make this big cut, get us, it says here 500 billion, whether that's just a real number or not, we're not sure. But we were hoping that they were going to get us 500 billion, $1 trillion in spending cuts, and that was going to hopefully make this job a lot more easier. Well, that unfortunately didn't happen. So now we're back to Congress has got to get dirty, right? Congress has really got to get in. They got to dig in there, and they got to cut some of this spending. The defense spending. I'm sorry. I love the military as much as anybody. I want us to have a strong military. Almost $1 trillion on defense. I'm having a hard time with that one. Could we cut 300 billion out of this? Maybe get us back down to $600 billion. Is there a lot of waste in this money? Yeah, I think there absolutely is. But you got to get in there and you got to dig in there and make hard cuts, right? It's got to, that's a tough thing. But anyway, so I think I have a tendency to agree with the sentiment here of the American Bankers Association, basically saying that, yes, this ultimately was a really good thing, and it is going to help to boost the economy over the next couple of years. Now, let's take a look here. So this is tax changes under Trump's big, beautiful bill in one chart. So I thought this was kind of interesting. So I thought we could go down here. So key individual tax changes from Trump's big, beautiful bill, current law versus the final legislation. So we all have the standard deduction. So right now, currently, it's $15,000 for a single individual and $30,000 for a married couple filing jointly for 2025. Well, in the final legislation, that's going to increase to $15,750 for a single individual and $31,500 for a married couple filing jointly for 2025. The bonus deduction for older adults. So right now it's $1,600 for age 65 and older for 2025, $2,000 for unmarried or not surviving spouse for 2025. And that is going to increase to $7,600 for age 65 and older, $8,000 for unmarried, not surviving spouse, both from 2025 through 2028. So, a nice bump there. State and local tax deductions for SALT. So $10,000 limit through 2025 is current. The new final legislation is going to be a $40,000 limit for 2025, increases by 1% through 2029, reverts to $10,000 in 2030. So again, for all the income earners in higher states like Connecticut, New York, New Jersey, obviously good news for you there. Child tax credit. So the max credit of $2,000 per child through 2025, refundable portion $1,700 for 2025. That's the current law. Per the legislation, max credit of $2,200 per child, refundable portion $1,700 for 2025. Estate and gift tax exemption. So 13.99 million for a single individual, 27.98 million married filing jointly for 2025. That's current law. The new one would basically go to 15 million for a single individual and 30 million for a married filing jointly for 2026, and that is for the estate and gift tax exemption. Now we get into some of the really good ones. So no tax on tips. So deductions of up to $25,000 per year from 2025 through 2028. So no tax on tips. Obviously, that is going to prove to be incredibly popular. Incredibly popular. The next one, overtime pay. Deduction of up to $12,500 per tax year from 2025 through 2028. Again, that is going to be incredibly popular. One of the ones I'm really looking at, this is really interesting, auto loan interest. So deduct up to $10,000 of annual interest on new loans from 2025 through 2028. I believe there's a caveat, though. The car has to be built in America. Now, I think the thing to look at there is what is the definition of built in America? Like, in other words, if you look at a lot of cars today, they are assembled in America, not necessarily built in America. So I think that becomes a little bit of a question there that I would love to get more. It'll be great to see in the coming months a little bit more clarification on that. But yeah, I mean, if you could go out and buy a new Ford or GM or a Jeep, something there that's made in America, and you can now write off the interest on that. Oh my gosh. I mean, that's going to be a boom for the auto companies. I mean, they're just gonna, they're gonna be all over that. Trump accounts for child savings. So one-time $1,000 credit to account per child born between 2025 through 2028. Again, I think this is going to prove something to be hugely popular. And then the last one here, charitable deductions for non-itemizers. So nothing there in the current law, and now it's going to go to $1,000 for single and $2,000 married filing jointly, and then it's going to be permanent after 2025. So again, charitable deduction for non-itemizers. That's a good thing. I think that will help out. But again, I think a lot of good stuff here. So you got your standard deductions going up. You got the bonus deduction here for older adults. Some of the people in the higher states with higher values on the SALT tax, good stuff happening there. Child tax credit gets a little bump. A state and a gift tax exemption gets a little bump. But obviously the big ones, no tax on tips, overtime pay, auto loan interest deduction, Trump accounts for child savings, and then charitable deduction for non-itemizers. All things that I think will help dramatically in the economy, and I think things that will prove incredibly popular. I think Congress in 2028, when a lot of this stuff comes back up, I think Congress will have a very difficult time getting rid of these things or not making these things permanent. So again, great stuff there looking at in the bill. So again, we'll keep an eye on this, and we will, we'll see what happens. We just got to give it some time and see how the rest of the year plays out. But like I said, just to go back to echo, just to re-echo the American Bankers Association, I agree with their sentiment that this legislation will unquestionably be good for the U.S. economy over the next few years. So I agree with that, and we will see what happens. Now, obviously, the other big news of the week was this blowout June payrolls. So 147,000 jobs added, smashing expectations. Unemployment rate drops to 4.1%. Now, the funny thing here was that ADP released their report just a few days earlier. And I've been ragging on ADP for years and years and years, man. I hate to say it, they suck. Okay. They suck. And their projections are just never right. And here, I mean, it was shockingly bad how bad they were basically came out a few days earlier saying that, the jobs are going to be negative. We're going to lose 33,000 jobs. And of course they start, the guys at Zero Hedge, they pull no punches. So they start right off the bat, jumping right into this. So after yesterday's shockingly bad ADP print of negative 33,000 jobs, the market was braced for the worst, with the whisper number for today's payrolls sliding to 96,000, the first sub 100,000 print and far below the consensus of 106,000. And many even contemplated how to trade a stagflationary recession print. In the end, it turned out to be just another head fake by ADP, which now has the same credibility as the University of Michigan. Because moments ago, the BLS published a blowout jobs report. In June, the U.S. added 147,000 payrolls, blowing away the median estimate of 106,000 and higher than the upward revised May print of 144,000 jobs. And there you can see the chart there, how jobs since January have actually been trending. The jobs report has been trending upward, which is fantastic news. There was just one economist who predicted a higher number among the 79 polled by Bloomberg who expected a higher print. That was Derek Holt at Scotiabank with 160,000. Everyone else was below the 146,000 number. Remarkably, in a dramatic change from the Biden tradition, previous months were revised higher. April was revised up by 11,000 from 147,000 to 158,000. And the change for May was revised up by 5,000 from 139 to 144,000 jobs. So, and it wasn't just the headline print that surprised to the upside. Perhaps an even bigger surprise was the unemployment rate, which dropped from 4.2 to 4.1%. Denying expectations of an increase to 4.3% and far below the Fed's recent upward revised estimate of a 4.5% rate. Among the major worker groups, the unemployment rate for blacks, 6.8%, jumped in June to the highest in 4 years, while the rates for adult women, 3.6%, and whites, 3.6%, decreased. The jobless rate for adult men at 3.9%, teenagers at 14.4%, Asians at 3.5%, and Hispanics at 4.8% showed little or no change over the month. The drop in the unemployment rate was the result of a 93,000 increase in employed workers, offset by a decline in the civilian labor force to 173,000 from 170,000, and a drop in the number of unemployed workers from 7,200 to 7,100. Labor force participation rate changed little at 62%. I'll tell you what, if we go back to the debt clock here, we can see the labor force participation rate right here. So basically we could see here, U.S. population, where is what I'm looking for here? Not in the labor force right now. So 102 million people currently not in the labor force. Full-time workers, 134 million current full-time workers. Part-time workers, 128 million part-time workers. So again, just to give you guys some, and now obviously the participation rate continues to remain around 62%. And again, kind of being, flat there, but it's the lowest in 2 years, and the unemployed population ratio held at 59.7%. Let's see here. There was good news on the inflation panic Fed. So average hourly earnings rose just 0.2% month over month, below the 0.3% expected, and down from 0.4%, while the annual earnings growth was 3.7%, down from a downward revised 3.8% and below the 3.8% estimate. So, and then some of the other elsewhere things. So more details from the report. So in June, the number of long-term employed, those jobless for 27 weeks or more, increased by 190,000 to 1.6 million, largely offsetting a decrease in the prior month. The number of people employed part-time for economic reasons at 4.5 million changed little in June. The number of people not in the labor force who currently want a job was essentially unchanged at 6 million in June. Among those not in the labor force who wanted a job, the number of people marginally attached to the labor force increased by 234,000 in June to 1.8 million. And the number of discouraged workers, a subset of the marginally attached who believed that no jobs were available for them, increased by 256,000 in June to 637,000. So taking a closer look at the job breakdown, we find that in June, job gains occurred in state government and healthcare. Federal government continued to lose jobs. So government employment rose by 73,000 in June. Employment in state government increased by 47,000, largely in education, plus 40,000. Employment in local government education continued to trend up at 23,000. Job losses continued in the federal government, negative 7,000. Where employment is down by 69,000 since reaching a recent peak in January. Healthcare added 39,000 jobs in June. In June, social assistance employment continued to trend up at 19,000. Let's see here, the part-time workers now, but wait, there's more. So whereas in the past, the BLS was known to pad the top line number thanks to part-time jobs at the expense of part-time. That was not the case this time, as full-time workers rose by 282,000, while part-time workers tumbled by 367,000. So, and last but not least, and perhaps most important, the number of native-born workers surged by 830,000 to a record 132 million, while foreign-born workers tumbled by 348,000 to 31 million, the lowest this year. So obviously, overall, this was a stellar job report, at least relative to expectations, and one which was not only sent yields and other dollar and the dollar soaring, with traders wrong-footed by the politically motivated ADP once again, but odds of a July rate cut pretty much gone, and odds of a later rate cuts in 2025 also sliding rapidly. So people do not think, or at least Wall Street does not think, that Jeremy Powell is going to cut rates anytime soon. And then they couldn't resist here. They had to take one last shot at ADP on the way out the door. Oh, and finally, never listen to ADP ever again. Yes, you got to love it. Those jokesters over at Zero Hedge just couldn't wait to just stick that knife in a little harder. I'm sorry, man. The guys at ADP, they need to be embarrassed. Okay. Embarrassed. It's that wasn't a little miss. That wasn't off by a little. That was like worse. They're predicting negative 33,000 jobs, and the jobs are up by 147,000. That's got to be the large. I think I heard somebody say that was like the largest miss they've ever made. So you gotta, it's guys at ADP. Hopefully you guys are looking at your numbers there a little bit this week. So, okay. I wanted to go through a couple things with everybody here. I did have US, let's see if we can make this a little bit bigger so that everybody can hopefully see this. So here we have US revenue. Yep. Annualized tariff revenue, like I said, up here is just, going up, which is fantastic. I mean, you love to see that straight line there. Schwab has emerged as the dominant broker post-TD acquisition, with over 60% of recent retail trades now routed through the platform. This is kind of interesting stuff there. Treasury cash down to $409 billion. There you go again. Another reminder that ADP is hot garbage when it comes to predicting the BLS job numbers, which not only beat expectations in June, but showed more jobs added in May and April than previously estimated. So Bitcoin joins gold as a mortgage asset. We'll have some more on that a little bit later. The debt ceiling has greatly reduced the demand for loanable funds. At the same time, the Fed has slowed its runoff of treasuries to almost nothing. The result is the reverse repo market soaking up the excess liquidity. It all vanishes very soon. What does that ultimately mean for us? That's a great question. Despite the poor showing in May, full-time work year over year is still up 1.5 million, or 3 times the increase in part-time jobs. So again, I think two key factors. While again, and let's not overblow it. I mean, 147,000 is not great. I mean, I think that if the job market is really humming, what you really want to see is probably a number between 250 and 300,000 jobs added every month. That is really the sign of a very robust economy. I think what you're seeing now is that, first of all, some of the bad numbers that were being floated out there over the last couple of years are now starting to get back to positive numbers, and you're starting to see this shift go back. But you're also seeing these monumental shifts in, wages are going back up. You're seeing big improvement in wages. You're seeing more full-time jobs being added as opposed to part-time jobs. You're seeing, there's better paying jobs out there. You're also seeing that jobs are going back to American citizens again instead of foreigners that were coming in here. These are all great trends that you're seeing in the jobs report, and these are the trends. These are the trends that we really want to continue. Not only did federal government jobs decline yet again in June, but BLS even reminded folks that tens of thousands of workers are still being counted as employed, even though they're basically already either out or halfway out the door. Expected declines in federal payrolls to continue. And we'll talk more about crypto. The economic FOMC statement red line. Again, no, this is from June 18th. Okay, so here, June 7th. All right, we're not going to... federal workers down for the 5th month in a row. Okay, June 18th. All right, we'll go back to that. We'll get back to that. Yeah, then here, last one on this. Almost 1.4 million more native-born Americans had jobs in May compared to 1 year prior. Annual employment growth for this cohort exceeded foreign-born workers by almost 700,000. What a difference a president can make. So again, the jobs shifting back to American citizens again. Exactly. Again, and I would just say this on a kind of a side note. One of the things that always blew my mind over the last 2 years was the fact that you were seeing literally 97% of all the jobs were going to foreign-born workers. It was just unbelievable. And I just thought that was like one of just this monumental scandal in the Biden presidency, the Biden administration, and the fact that was just getting like zero coverage was always just mind-boggling to me. But I think you saw it. I think you saw it in the election ultimately, because people, again, even though the business media refused to cover it, obviously people saw it in their everyday experience with their own eyes when they're going to try to get jobs and things of that nature. But again, just unbelievable. So, but again, I'm very happy that everything seems to be in this jobs report heading back in the right direction. So, all right, so let's switch gears and let's talk about tariffs for a minute here. So Bessent. So tariffs will boomerang back to April levels by August 1st for countries without deals. So Treasury Secretary Scott Bessent said President Donald Trump will send letters to some trading partners saying tariffs will boomerang back to April 2nd levels on August 1st if there is no progress. Bessent rejected that August 1st is a new trading deadline, but it could still give countries more time to negotiate. Bessent also said that he expects to see several big announcements over the next couple of days about trade deals. So Treasury Secretary Scott Bessent said Sunday, that's today, that tariffs announced back in April will take effect on August 1st for countries that have not reached an agreement with President Donald Trump's administration. President Trump's going to be sending letters to some of our trading partners saying that if you don't move things along, then on August 1st, you will boomerang back to your April 2nd tariff level, Bessent said on CNN's State of the Union. August 1st, countries will get a letter stating that if we have not reached an agreement, then you will go back to the April 2nd level, he said. Bessent rejected the idea that August 1st is yet another new tariff deadline, but the August date could still give trading partners more time to renegotiate tariff rates. We are saying this is when it's happening. If you want to speed things up, have at it. If you want to go back to the old rate, that's your choice, Bessent said. In April, Trump announced a 90-day pause on steep tariffs he had unveiled just days prior on most major trading partners. That 90-day pause is due to expire on Wednesday, July 9th, sparking concerns among investors and U.S. trading partners. So, I think what's happening here is that a lot of countries, especially Europe, they're basically trying to play chicken here. They're trying to play chicken. They're trying to see, okay, who's gonna blink first? But Trump's not gonna blink. He's not gonna blink. I hate to break this news to people, but yeah, he's not blinking on this. And my guess is that some countries will make deals. I think India is on the verge of the deal. I mean, obviously, we did get some good news with China. I think there will be more to that China deal in the coming weeks and months. I think that was just kind of the opening salvo, if you will, or the first phase or first part, however you want to state that. So there will be more to come with that. Obviously, the deal with Vietnam was a huge deal this last week. And, we are going to continue to see a lot more on this front. And again, I think there probably will be some holdouts and they're going to get nailed. I mean, I have to laugh at Canada. I mean, I really do. I mean, it's so bad. I just don't know what they're thinking. They went back and basically said, "Oh yeah, we're not going to negotiate, and we're going to hit the U.S. with this digital services tax, and we're going to make it retroactive. And how do you like that?" And I literally laughed when I heard that because I said, the only person you're hurting is yourself. Like, you're killing your own country, and for what? Like, all Trump wants to do is negotiate to make things more equal. That's it. That's it. Like, don't be stupid. Just go in, cut a deal that works for both sides, that everybody can live with, and then let's move on. Like, it's just this absolute stupidity. But unfortunately, the guy in charge up there in Canada is actually it's a dude from Europe, and and I think he's taken his marching orders from his buddies back in Europe, unfortunately. And it's just stupid because they're just going to shoot themselves in the foot. And no surprise, they immediately backtrack a couple days later and say, oh no, we're not going to charge that tax. We're just completely pulling out of that. No harm, no foul. Sorry about that. We're not going to do that. And you just have to sit there and laugh. You're just, because I'm just, what are you doing? What are you doing? I don't get it. I think it's just the stupidest thing in the world. But we'll see. We'll see. They'll get the message at some point. They're just hurting themselves, and they, and again, it would be one thing if you had leverage. Like, China does have a lot of leverage over us, in terms of the rare earth minerals, and they buy a lot of our national debt, and they make almost anything and everything in the whether it's clothes, toys, whatever, it's all coming out of China. So China's got some play there, man. They got some leverage. Canada's got no leverage. They got zero. They got nothing. Nada. They're getting a $250 billion a year subsidy from us. Like, for what? Like, what do we need to give that? We don't need to give that to them. We can just take it away. And what are they going to say about it? Nothing. They're going to say nothing. So I don't. It's just, yeah. So it's interesting stuff there. So a lot more to come on the front with tariffs. So now I saw this article, and this was really good. So I've talked a lot about private credit. I have a very big fear over the private credit. I feel like private credit has become this runaway train in the financial markets, and I just do not have a good feeling about where this is going. And then in the Wall Street Journal this week was this article: a pioneer in private credit warns the industry is ruining its golden era. So Sixth Street's Alan Waxman says his publicly traded rivals are turning private credit into a commoditized business, and he isn't following suit. Now, I think this article states perfectly what I have been talking about with private credit. So let's go into this for a couple minutes here. So private credit is in a golden age. So the biggest firms are marching further into bank territory, raking in money from insurance companies and individual investors, and setting their sights on the trillions of dollars in U.S. retirement accounts. Don't get me started on that. Don't do it. Just don't do it. Don't go there. I really hope we don't get there, because that will not end well. But one of its pioneers thinks the industry is losing track of what made it great. Alan Waxman, CEO of investment firm Sixth Street, says publicly traded rivals such as Apollo Global Management and Blackstone have reoriented their credit businesses to take in huge sums of money from insurance companies and individual investors. That means money flows in and must be put to work quickly, whether or not the investment opportunity is ripe. Kind of sounds like a little bit of a mania, right? Sounds like a little bit of a bubble forming, right? A massive credit bubble. This is what happens. the money just keeps flowing in. So, and what I've said is that private credit is a beast. It was a beast created from the Fed, created by the Fed, basically in the search, the reach for yield during the quantitative easing and the ZIRP policy days, zero interest rate policy days. That was what gave birth to private credit. And now this thing has exploded in the last 5 years and is, like I said, it's turned into a runaway train. So they're literally just throwing money at stuff. That means money flows in and must be put to work quickly, whether or not the investment opportunity is right. Meaning whether or not the investment makes any sense at all doesn't matter. They got to just continue throwing money into this thing because this thing's got to keep growing. You've got to feed it. The 50-year-old Waxman, who in 2000 created one of the first private lending businesses while at Goldman Sachs, isn't predicting this will end with a blow-up. Of course not. Instead, he argues these firms are turning private credit from a bespoke type of investing with relatively high returns into a commoditized, low-returning business. No, they don't have a choice. They have to keep feeding this thing. That's the whole point. It's a credit bubble. And when credit bubbles go, they go and they go and they go until they blow up. Okay, that's what happens. His rivals, Waxman say, have become factories, churning out deals with little consideration of their long-term prospects, i.e. they're doing every BS deal, crap deal under the sun because they got to keep this thing rolling. Kind of sounds familiar, right? Kind of sounds like maybe this thing that happened with the real estate market, I don't know, back in 07, 08, 09, the implosion of the real estate market kind of sounds like this thing called the dot-com bubble back in the late 90s. Yeah, kind of rings, kind of smacks of that, doesn't it? What does a factory do? He asked a room full of Sixth Street investors at the annual meeting in October. Well, I want to get as many widgets out the door as fast as possible, as cheap as possible, regardless of what the environment is. Waxman's warnings come at a sensitive time. Some institutional investors are already starting to complain private credit isn't living up to its prior gains, and regulators are evaluating ways to make it easier for 401k investors to participate in private markets, which is mind-boggling. So the answer is not to pump the brakes on private credit. I just did an episode a couple weeks ago. I would highly recommend everybody go check it out. Let me see what episode that was real quick. All right, hang on one second here because I want to look this up because this is very important. Yeah, go back and look up episode 404. Fed warns banks private credit ties create systemic risk. Go back and look at that. Go back and watch that episode, and you'll get exactly what I'm talking about. The Boston Fed just did research and basically came out and said, yeah, you want to be really, really careful because we are starting to see some highly concerning things in this private credit market, and you better watch out and pay attention. I also have gone over some other articles. I believe it was the CEO of Zions Bank basically came out and he warned. He was highly troubled by the private credit market and what was going on there. And he was seeing that because of things that, Zions Bank, his bank was doing. So again, this is just, again, I like I've said before, I think in, my humble opinion, if there's a spot in the market that you should be worried about, it should be private credit. If there is a part of the market that is going to potentially blow up or implode, it's private credit. This is where the next thing is coming. His critique is also convenient for Sixth Street, which has been late to the biggest trends fueling private credit's growth. It was years behind Apollo's move to manage assets for insurance companies, and Sixth Street has yet to offer products aimed at individual investors who now account for nearly a quarter of Blackstone's assets under management. Waxman thinks Sixth Street can withstand the tide. He regularly gets calls from bankers arguing that the $115 billion firm, one of the last big standalone private credit specialists, needs to embrace the factory model to stay relevant by selling to a bigger asset manager or going public. He argues Sixth Street's structure encourages collaboration, helps it attract top talent, and allows it to remain flexible, putting billions of dollars to work by constantly pivoting. Yes, I would concur with that. Yes, absolutely. And I think that what he's thinking is, hey, when this sucker blows up, I'm going to be there to pick up the pieces. I'll be there to I'll be there to pluck off the really good deals that are still remaining while everybody else is sifting through and working through all the garbage. And then it just goes into a bunch of other things in here. So I'm not going to get into all this stuff. This was the main thing that I wanted to bring you guys on this private credit outlook. And again, this article talks about what I have talked about, and that is, it's turned into a factory. The money is just coming in and it's got to go out. They got to put it to work, and they're getting lower returns. They're just throwing money at anything and everything that's out there. It doesn't matter how bad it is. They're going to throw money at it. And this is the problem. This is the problem. This is the very epitome, the very definition of a credit bubble. And this is not going to end well. I can guarantee it's not going to end well. 30 years of experience tells me that this is not going to end well. So, okay. Let's go on and look at some other things. So India, this I thought was funny. This I thought was really funny. India cracks down on Jane Street's lucrative derivatives trades. So the New York-based trading firm disputes findings that it moved market prices for profit. They would never do that. Never. India barred Jane Street from its financial markets, planning to seize $570 million from allegedly fraudulent trades. The regulator alleges Jane Street manipulated stock derivatives, misleading smaller traders to boost profits. I am just shocked. Just shocked. Jane Street disputes the findings and will seek further engagement while affirming its commitment to compliance. India has barred Jane Street from the country's financial markets and said it would seize around $570 million that the U.S. securities firm made from allegedly fraudulent trades. The Security and Exchange Board of India said the U.S. firm has moved prices in stock derivatives and cash markets for the firm's benefit and misled and enticed smaller traders to boost profits. The regulator said the firm made a profit of around $4.3 billion from its trading in Indian markets between January 2023 and March of 2025. A Jane Street spokesman said the firm disputes the regulator's findings and will seek further engagement, adding that it is committed to complying with all regulations where it operates. Privately held Jane Street has emerged as a rival to Wall Street banks and liquid corners of markets where it can trade and deal securities at a lower cost. The firm uses its own money to take advantage of price differences and uses algorithms, trading speed, and human skill to identify winning trades. So anybody doesn't know, perhaps the most famous person to come out of Jane Street was a guy named Sam Bankman-Fried. In the crypto series I detail all of that lovely story. If you want to go check and get the backstory on that. So Jane Street basically started out as a high frequency trading firm on Wall Street. They have done very well for themselves, but they have come with a lot of controversy over the last couple of years. They basically prided themselves on flying under the radar. They did not, Jane Street does not like, they do not like press. They do not like being out there. And you got to ask, well, why is that? Is that because maybe some of the things that you're doing are a little shady? Maybe there's some truth into that. I don't know. That's for them to answer. That's for them to put out there. All I can do is report on what I see. Now, I will say this on another little side note. This article was buried in the back of the Wall Street Journal, and what I find. What I have found increasingly interesting, and I'd say that this is a pattern that I've seen over the last probably 4 or 5 years, is that a lot of the best articles have a tendency to be buried at the very back of the Wall Street Journal in the business section, business and investing section. And I find that very interesting because I'm always like, why are the most interesting, articles like this, why are they always buried at the back? Just an interesting thing that I have noticed. So, all right. So I'm going to come back to this. I've got a series of articles here I want to run through real quick. I've got a bunch of like kind of updated crypto news. I got a bunch of AI news that I want to run through with everybody. But what I'm going to do right now is for just a couple minutes, I want to pivot in to, well, I want to talk about the episodes that I put out this week, which I always do. And then I want to talk about the economic indicators coming up this week. So, and you know, as a matter of fact, I'll bring this back up here. So we'll talk about economic indicators for a second here, since this is always like to cover. Now, I'm showing you guys this because I didn't get my normal sheet this week because unfortunately, you know, July 4th was on Friday and I guess everybody was off. So I did not, the usual sheet I usually get from the company I usually get it from was not there. So I did not get that, but I did get this. There's always a backup. All right, so let's run through this. So this week's major U.S. economic reports and Fed speakers. So on Tuesday, Tuesday, July 8th, let me get the date right here. We get the NFIB Optimism Index and we get consumer credit. On Wednesday, July 9th, we get wholesale inventories and we get the minutes of the Fed's May FOMC meeting. On Thursday, July 10th, initial jobless claims. U.S. Fed President Alberto Musalem is going to speak, and San Francisco Fed President Mary Daly is going to speak. And then Friday, June 11th, we get the monthly U.S. federal budget. Now, this week's major U.S. economic reports, basically nothing really coming out on Monday this week. A lot of stuff. Tuesday, July 9th, we get Consumer Price Index. We're going to get the CPI report. We're going to get the Empire State Manufacturing Survey. On Wednesday, July 10th, we're going to get the Producer Price Index, and we're also going to get the Fed Beige Book. On Thursday, July 11th, like I said, initial jobless claims. We're going to get U.S. retail sales. We're also going to get the Philadelphia Fed Manufacturing Survey, Home Builders Confidence Index, business inventories. And then finally, on Friday, July 12th, we're going to get the housing starts, building permits, and consumer sentiment. So got some Fed speakers. Like I said, we're going to see the Beige Book. We're going to see some Fed. We're going to see the Fed. We're going to see the minutes of the Fed's May FOMC meeting. And then we got a lot of, initial jobless claims. We're going to get some inflation numbers with the CPI and the PPI. We're going to see retail sales, some manufacturing numbers. So a good amount of economic data coming out this week, but nothing really happening on Monday. And then Tuesday, Wednesday, Thursday, we're going to get a lot of stuff and then a little bit of stuff on Friday. So that seems to be how the week is going to shape up from an economic indicator standpoint. So, okay. Let me switch up for just a second here. And I want to talk about what were the episodes that I had come out this week. So, okay. So on Monday, I did episode 415, which was a new Genesis for the crypto winter of 2022. So that was the 23rd installment of the crypto series. So basically this part, in this episode, we review an article from the Wall Street Journal titled "Crypto Billionaire is Accused of Fraud." So Barry Silbert, one of the original crypto moguls, is being accused of fraud through his defunct company Genesis Capital. Thus the Genesis, play on words there. What makes this really interesting is that the creditors in the case allege that the crypto winter of 2022, that was basically the crypto market collapse in 2022, that most believe started with two crypto tokens, which were Terra USD stablecoin and the Luna token, actually started in 2021 with Grayscale Bitcoin Trust. This case could end up rewriting the history of what ultimately caused the collapse in crypto markets in 2022. So yes, we will have to follow this lawsuit and this case very carefully because this could bring out some really interesting information and shed a lot of light on what maybe was the true cause or the true thing that kicked off that crypto winter, basically the collapse of the crypto markets in 2022. So again, thought it was a really interesting episode and definitely something we'll have to follow up on there. Then on Tuesday, Episode 416, I did a review from the OCC, the Office of the Control of the Currency, put out a couple of first quarter 2025 reports, basically reports on mortgage metrics and bank trading and derivatives activities. So this episode examined two reports from the Office of the Controller of the Currency. Both reports are for the first quarter of 2025. The first report is OCC Mortgage Metrics Report, and the second report is a quarterly report on bank trading and derivatives activities. So the mortgage metrics report showed that 97.6% of mortgages were current and performing at the end of the quarter. So things looking pretty good there. The bank trading and derivatives report showed the cumulative trading revenue of U.S. commercial banks and savings associations was $15 billion, and derivative notional amounts increased by $23.9 trillion or 12.8% to $210 trillion. So again, check out those two reports. There was also a lot of really good nuggets in there as well. On Wednesday, I put out episode 417, which was a review of Bank Directors 2025 Compensation and Talent Survey. So this episode examined an article from Bank Director titled 2025 Compensation and Talent Survey, Powering the C-Suite, and the Bank Director 2025 Compensation and Talent Survey. The key findings from the report include measuring CEO performance, hiring plans level off, DEI programs decline, handling mishires, headcount plateaus, and costs continue to rise. That is a great report. It's a great survey, I should say, that Bank Director puts out every year. I would highly recommend, if you have not, reviewed that, definitely watch the episode and look at that report, because there really are a lot of really great nuggets and a lot of great things in that report. Then on Thursday, episode 418, the big interview with former Fed Governor Dr. Thomas Honig. And basically, this continued the Lords of Easy Money series with an exclusive interview with Dr. Thomas Honig. Dr. Honig is the former Fed governor of the Kansas City Federal Reserve Bank and former vice chairman of the FDIC. Dr. Honig is the main character in the book, The Lords of Easy Money by Christopher Leonard. Dr. Honig became famous for his dissenting votes during the FOMC meetings in 2010, along with his warnings about prolonged easy money policy. And I would just say, if you haven't had a chance to check out that interview, please go back and check it out. Like I said, people are just absolutely loving that interview. I have gotten a ton of positive feedback on that over the weekend. I think it was, and again, I specifically wanted to release that basically on Thursday leading into the 4th of July weekend, hopefully giving a lot of people a chance to watch that, as maybe they're just lounging on the beach or sitting around in their backyard barbecuing or whatever you might be doing. But again, that seemed to absolutely work, because a lot of people watched it. So, which was great. And a lot of feedback. But again, it was a very, very important interview. I really appreciate Dr. Honig doing that, spending that time with me and doing the interview. I thought it was a fantastic interview, and I really, really do hope he will come back and join us again in the future. Maybe not necessarily talk about this. It could be talk about anything, just what's going on in banking, whatever. But his insight is tremendous. I mean, he's just a highly experienced individual who's done a lot of things in his career. And, again, one of those guys you just always love talking to. So, and then finally on Friday, I actually did something a little bit different. I did a 4th of July special 2025, and a little bit of a book review. I basically covered Adam Smith and the Wealth of Nations, something that I have wanted to do for a long time, but was kind of waiting for the perfect opportunity to do it. So basically this episode, it was a book review for the Wealth of Nations, but we discussed not only the book, but the author, Adam Smith, the context around the year it was published in 1776, and its enduring influence. The Wealth of Nations is considered the cornerstone of modern economics, shaping capitalism and policy worldwide. The Wealth of Nations is a masterpiece that birthed capitalism and fueled America's economic rise. The importance of that book and the economic ideas within cannot be understated. It is absolutely it's a must-read book. Like, in order to understand capitalism, in order to understand our economic system, in order to understand why the founders chose that to be the economic system for our country, the driving economic force, if you will, behind our markets, free market capitalism. If you want to understand that and understand how it works or how it's maybe supposed to work, you need to again read that book. Now it is, I detail this in the episode. It's a dense book. It's a hard book to get through. It really is, because it's basically 6 books in one, and it's not written for the faint of heart. I'll put it that way. You got it. Again, you have to spend some time with it. It takes a while to get through, but I promise you, if you could get through it, your basis and understanding of our economic system will go from here to here, and you will have a much better idea. And you will also be able to engage in conversations on a much deeper level when economic things come up and people say, "Oh, our government's proposing we do this." You're going to say, hey, wait a minute, time out. Yeah, I read this little thing called The Wealth of Nations, and that wasn't in the book. But again, just to point out the fact that this book was written almost 250 years ago now, and it hasn't waned. Everything that's in that book is true back then as it was today, and many things in the book are still hotly debated, which I think is fantastic, and it's a testament to the staying power of the book and the ideas within. So again, hope everybody liked that. Hope everybody gets a chance to check out those episodes. Now this week, I've got a very interesting week coming up here, where basically I'm going to be doing what I call book week. So I've been waiting to do this for a while, and so I've got 5 different books with 5 different characters, all from different parts of the financial services landscape, coming in here. So we're going to be covering Donald Trump and Trump's The Art of the Deal. We're going to be covering John Paulson in The Greatest Trade Ever. We're going to be covering John Law in the book Millionaire. We're going to be covering the life of Jesse Livermore, one of the greatest traders that ever lived, in the absolute classic Reminiscence to a stock operator. And then finally, the man, John Jacob Astor. If anybody has never read or has never seen or gone over anything about John Jacob Astor, absolutely, you want to watch this. I think you'll be blown away by. He set the template. It's just very simple. John Jacob Astor. He set the template for what we think of as millionaires, the rich, philanthropy. He did it. He set the template for it all, and everybody that basically has followed thereafter was basically just copying him in one way, shape, or form or another. So it's just he's a very interesting individual to study his life and study what he did. Like I said, I think Penn has a whole class that they devote to just studying the life of John Jacob Astor. That's how much stuff is in his life and how many things he did, which is just absolutely amazing. So that's book week coming up this week. I hope everybody will really enjoy that. So with that said, let's get back to some articles here. I've got some articles, some stuff here I wanted to run through. So this is basically the end of bank branches, how Europe's digital euro and stable coins are reshaping finance. So the digital age is dawning. Repetitive tasks are being automated, and technologies like artificial intelligence and autonomous vehicles are reshaping our daily lives, just as the financial sector is undergoing a profound digital transformation. The slow disappearance of physical bank branches is one of the clearest signs of this upheaval. The desertion of Germany's town centers is a symptom of this new era. High rents, shrinking consumer power, and demographic decline, especially in rural areas, collide with the shockwaves of e-commerce and a rapidly digitizing economy. More and more of our consumer habits are migrating online, and the banking industry, long anchored by its brick and mortar branches, is no exception. And then we get into kind of a long-term trend. So the quiet death of Germany's bank branch network has been underway for years, a global phenomenon driven by consumers embracing online banking, decentralized access to investment portfolios, and other digital financial services. The latest data presented by Barco Consulting on behalf of the European Central Bank confirms this trend. In 2023 alone, German banks closed approximately 560 branches, a 2.8% reduction. That may sound like a modest consolidation, but in context, it's part of a decades-long structural shift. 10 years ago, German banks operated more than 35,000 branches. A quarter century ago, that number was closer to 60,000. Today, only 18,933 remain. And then it goes on to say basically Deutsche Bank is leading the way, multifaceted pressures, digital euro and stable coins. It basically says here at the end, so now the next tidal wave is approaching, the rise of stable coins. Digital currencies pegged to fiat currencies like the US dollar heralds the next level of direct banking. Stable coins offer fast, low-cost, round-the-clock global transactions without intermediaries like traditional banks. As decentralized finance, DeFi, grows, traditional banks are losing their roles as payment processors and credit intermediaries. Again, for all this kind of doom and gloom out there, I don't, again, this stuff is moving this way. I think that there is something a little bit more, I would say, sinister at play in Germany in terms of them wanting to basically get rid of bank branches. I mean, I think the Germans and the BIS, the Bank of International Settlements, and the European Union, they've been on this whole kick. They want to create their own central bank digital currency, and they want to make everything digital, and basically just have you just stuck. And now again, this trend is in America too. I think we went from a high of like 96,000 bank branches, and I think we're down to like 79,000 bank branches. But my take, though, in America, will we ever see a day that there are no more bank branches? I hope not. And here's why. Because the human interaction still matters. It still matters. Particularly for community banks. If you're going to be a community bank working in the community, you need to employ people in that community. You need to be an employment source for people in that community. It's important with building and developing and maintaining relationships with your customers in that community. I don't think that is ever going to change. But here's another thing that people don't think about. All this digital stuff is great until the proverbial blank hits the fan. When the blank hits the fan, okay, then everybody's like, then they don't want to talk on the phone. They don't want to sit on some stupid automated phone system. They don't want to get pinged around for 45 minutes or an hour, not being able to talk to somebody about why they can't access their account or why they can't get their money. No, when that happens, they want to go down to the branch. They want to get somebody live and in person in front of them and basically say, okay, who is going to answer for this? Who is going to fix my problem? And I still think that is hugely important, and again, I would just say, if you're 25 or 30 years old and you haven't really experienced a really true banking crisis or a major market collapse yet in your life or your maybe young career, it will happen one day. And when it happens, it will change your perspective on a lot of things. Suddenly, being able to get a hold of a real person is going to matter. It's going to matter in a big way to you. when your money, your livelihood, your financial life is on the line, you better believe you're going to want to get a physical person in line. So, but again, I report on this to basically show these are trends, no doubt. I mean, these are trends that are coming in. And it's a great peek into kind of what's going on in Europe right now, particularly in Germany. And you'll see how some of these things kind of tie in. So let's go to this other one. So Euro stablecoin by DWS and Deutsche Bank gets regulatory approval. So all Unity A joint stablecoin venture by asset manager DWS and banking giant Deutsche Bank received a license from the German Federal Financial Supervisory Authority, the BaFin, according to a Wednesday announcement. So BaFin has granted an e-money institution EMI license to all Unity. With the license, the company plans to issue a regulated and BaFin licensed EuroPeg stablecoin, Eura, in compliance with the Markets and Crypto Assets Regulation, the MiCA framework. All Unity said Eura will feature institutional grade proof of reserves and financial reporting. The initiative, which also involves US based Galaxy Digital, aims to provide Euro dominated digital assets that integrate seamlessly into the workflows of regulated institutions, fintech platforms, and enterprise treasuries. Amsterdam based Flow Traders will serve as the project's liquidity provider. So, again, just more interesting. The stablecoin battle for Europe. The announcement comes as Europe emerges as a key battleground in the global stablecoin race following the full implementation of MiCA on December 30th, 2024. The development is partially due to the fact that the worldwide stablecoin market leader Tether has so far declined to comply with the MiCA framework. This led to USDT being delisted from Binance, as well as competitors such as Kraken and Coinbase for users in the European Economic Area. But again, no doubt they're watching all the things that are going on here in America as well, basically saying that, hey, we gotta keep an eye on this because we don't want to fall too far behind everybody else. Stablecoins race for MiCA compliance. So earlier this week, Paxos announced the launch of MiCA compliant global dollar USDG stablecoin in the EU. Mid-April reports revealed that the market cap of Circle's MiCA compliant stablecoin Eurocoin was growing quickly. Circle's stablecoins likely benefited from the implementation of MiCA, with Eurocoin and USDC reaping the rewards of its regulatory-friendly approach. The company's stablecoins are the top Euro and US dollar peg stablecoins that comply with MiCA. Still, Coin market cap data shows that the USDT remains the undisputed market leader. With a market cap of under 158 billion, USDT has a significant lead over the second largest stablecoin, USDC, with a market cap of less than 62 billion. So again, very interesting here. Ripple seeks a U.S. banking license, adding to list of crypto companies. So a national banking charter would make the OCC a regulator of Ripple's stablecoin. So Ripple has applied for a national banking license with the U.S. Office of the Controller of the Currency. The national charter would place Ripple's dollar-based stablecoin, RLUSD, under the OCC's regulatory remit. Ripple subsidiary Standard Custody and Trust Company applied for a Federal Reserve master account on Monday. So Ripple has applied for a national banking license, joining the rush of cryptocurrency companies seeking to cross the divide into mainstream finance. So Ripple, which manages cross-border payments in a dollar-backed stablecoin called RLUSD, filed its application Wednesday with the U.S. Office of the Controller of the Currency. Stablecoins are typically pegged to the dollar or other government-issued currencies, and more reserves in cash or safe assets such as treasuries to keep a one-to-one exchange ratio in place. RLUSD is currently subject to state oversight through the New York Department of Financial Services. A national trust bank charter would also place RLUSD within the OCC's remit. The dual nature of that regulation would basically have set a new bar for transparency and compliance in the stablecoin market, says Jack McDonald, Senior Vice President of Stablecoins at Ripple. In time, Ripple would consider offering other crypto services through its banking license. Separately, Ripple's subsidiary, Standard Custody and Trust Company, applied for a Federal Reserve master account on Monday. If granted, the account would allow Ripple to custody the reserves directly with the Fed and issue and redeem stablecoins outside of normal banking hours. This is a huge development, monumental development, in fact. So we have to keep an eye on what happens here with Ripple. I think this is a beautiful move on the part of Ripple, actually, because they get the banking license, they get the Fed master account. They're now being regulated by the OCC. They could keep the money at the Fed in their master account. Again, putting them on kind of an inside track on the regulatory side, again, adding to the legitimacy of stablecoins, particularly their stablecoin, the RLUSD. So again, I think this is a huge move. Whether all this gets approved and how quickly it gets approved and how quickly it all goes through, we'll see. Undoubtedly, there are a lot of other competitors running to do the exact same thing right now, but Ripple seems to be the first one out of the gate here, running in here. So I think it's a great move on Ripple's part, and we shall see how that effect plays out. And then here is another one. So Ethereum is powering Wall Street's future. The crypto scene at Keynes shows how far it's come. So crypto founders, developers, and some of the institutional giants gathered at the Ethereum Community Conference, or the FCC, in Keynes, France. Ethereum's institutional adoption is accelerating, with BlackRock, Deutsche Bank, Coinbase, and Kraken all building directly on its rails. Robinhood became the first public U.S. company to launch tokenized stocks on chain using Ethereum's Arbitrum network. So Ethereum is, started out as a cryptocurrency, but they have really become so much more than that. They have basically built this blockchain rail, if you will, this system, because they basically off of the Ethereum 2, what they call the Ethereum 2.0. And now they've developed this Arbitrum network, which obviously everybody is beginning to use. So Ethereum is really trying to put themselves at the center of the crypto world in a very real way. So Wall Street's new plumbing is being built on Ethereum. And this week, its architects descended on the same French Riviera villas and red carpet venues that host the Cannes Film Festival in May. The Ethereum Community Conference transformed the beachside town into a hub for crypto founders, developers, and the institutional giants now building atop the infrastructure. The crypto elite climbed the iconic steps of the Palais des Festivals, a cinematic landmark typically reserved for film stars, now repurposed for the stage for Ethereum's flagship European event. The atmosphere this year was palpable in Cannes, said Bettina Boone-Fuller, the powerhouse behind the Ethereum conference for the past 7 years. The prestige of the location, combined with the quality of talks, has reinforced Ethereum's stature and purpose in the wider ecosystem. Private parties sprawled across cliffside estates and exclusive resorts, but the conversations were less about price action and more about the blockchain's evolving role as the back end of global finance. Ethereum, now in its 8th year, has tracked Ethereum's trajectory from scrappy experiment to institutional backbone. The impact was unmistakable this year. From Robinhood embracing decentralized finance infrastructure via Arbitrum to local governments like the city of Cannes exploring deeper integration with the crypto economy. Indeed, one of the boldest moves came this week from Robinhood, which became the first publicly traded U.S. company to launch tokenized stocks on chain. Yes, and now that is a perfect lead-in to the next article here. So Robinhood goes all in on crypto with major product push. So the brokerage will allow European customers to trade more than 200 U.S. stocks and ETFs as digital tokens, and is developing its own blockchain. So Robinhood is launching a new crypto services aiming to become a central hub for digital assets. European investors can trade tokenized U.S. stocks and ETFs with zero commissions starting June 30th. Robinhood is introducing crypto staking for Ethereum and Solana in the U.S. So Robinhood Markets, the brokerage upstart that drew in millions of traders during the COVID-era meme stock frenzy, is making a significant push into crypto by launching a wave of new services designed to make its app a central hub for digital assets. The brokerage's new products will allow customers to do more than simply buy and sell cryptocurrencies. Robinhood will follow crypto exchanges Kraken and Gemini in announcing plans to offer tokenized stocks to overseas customers starting on June 30th. The company's European investors will be able to trade more than 200 U.S. stocks and exchange-traded funds over a digital ledger with zero commissions. Such tokenized equities would make it easier for foreign customers to access U.S. stocks such as Apple, Tesla, and NVIDIA, as well as popular ETFs, including the Spider S&P 500 ETF around the clock. Robinhood also plans to offer tokenized shares of privately owned companies to customers The trading platform is making stock tokens of OpenAI and SpaceX available to eligible European users this summer, executives said at a crypto event Monday. Now, we could get into a whole different conversation on this, because is that, these tokenized shares of private companies like OpenAI and SpaceX? Yeah, I think that's a lot of nonsense, because you're not buying stock in those companies. You don't have ownership in those companies. You're buying this kind of bastardized product in a way. This tokenized share. Again, I would be very, very careful with some of this stuff that's coming out here. Again, no doubt. I mean, you've got, these exchanges, Kraken, Gemini, Coinbase, Robinhood here. They're all going in on the crypto craze, the crypto hype, if you will, where we're going into it. We're moving into the next era in the crypto markets. Obviously, trying to make stablecoin a very legitimate, respectable type of investment product that a lot of people will use in different facets. So, and then obviously that taking a lot of the other digital crypto things along with it. But again, what we see here, though, is just an expansion of the plumbing and the technology amongst Wall Street, basically making it easier for people to invest in these things. So just as a quick recap, as we go back through these 5 articles again, end of bank branches, how Europe's digital euro and stablecoins are reshaping finance. We see this decline in bank branches in Germany. Deutsche Bank leading the way. Then we go into the next article here, basically where we talk about, Euro stablecoin by DWS and Deutsche Bank as regulatory approval. Again, pushing more into the stablecoins. Then we talk about how Ripple is seeking a U.S. banking license, adding to the list of crypto companies, again, trying to legitimize the stablecoin. And then we get into the big festival here by Ethereum. Hosting its 8th annual festival over in Cannes. Basically, now putting forth their plumbing, if you will, for the crypto markets with this new Arbitrum network, which everybody's jumping in on. And then Robinhood basically jumped in on that, and they go all in with crypto, major product push, which a lot of this will be built on the backbone of this Arbitrum network from Ethereum. So again, just very, 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 very interesting. So a lot of stuff happening in the crypto world, and it's going to have a major impact on the banking business, the banking industry, the global banking industry. That's why I'm following all this stuff. That's why I'm pushing in on it, because this is going to have major ripple effects, in the banking industry in the months and years to come. Okay, let's flip into AI for a second here. So, a couple of AI related articles here. CEOs start saying the quiet part out loud. AI will wipe out jobs. Ford chief predicts AI will replace literally half of all white collar workers. I mean, that's crazy. So several CEOs predict AI will significantly cut white collar jobs, marking a shift from previous reluctance to acknowledge potential job losses. Ford CEO anticipates AI replacing half of white-collar workers, while JP Morgan Chase expects a 10% operations headcount reduction via AI. Some, like OpenAI COO, believe fears are overblown, while others highlight potential for new roles despite inevitable job displacement. Now, again, I've said this before. My take on this is that I do think that AI will eventually, meaning in 5 to 10 years, will eventually begin to replace and take certain jobs. However, I think at the moment, in the next couple of years, what you're really going to see is that there's going to not be the need for banks and companies to hire additional people, because the AI is going to augment what people are currently doing. It's going to allow people to do a lot more in their current roles. So, and because they could do more, it's basically, think of it, you're adding capacity, right? So you're going to add capacity to what people can do in their current job function. And as you add capacity, they can do more. That means you don't need to hire as many people to grow. And I think that's kind of the first stage. That's kind of the first phase here. And I think we're still in the very early stages of that. This idea that like, oh, AI is going to take all of our jobs tomorrow. I don't know. Again, I use Grok and I use ChatGPT. I use these different things. Dude, I don't see it taking people's jobs tomorrow. With the quality of stuff that I see so far, yeah, it's a tool and it's a good tool, but I think some of this is a little overblown. But the point of this article is the fact that CEOs they're being more open about this now. They're not trying to beat around the bush anymore. They're not, oh, it might take jobs, it may not, whatever. But it is, and they're starting to acknowledge that. This next article here: digital workers have arrived in banking. So financial services companies like BNY Mellon and JP Morgan say AI capabilities are taking more and more cues from the way humans work. So BNY Mellon now employs AI digital employees with company logins working alongside human staff in areas like coding. Now, for anybody who doesn't know, BNY Mellon has always been one of the most cutting edge technological banks out there in the financial services industry. BNY Mellon, they've always been the tech bros of the banking business, so to speak. So this is not, so I just say that just so that you understand who they are and what they do and what they're all about. So none of this is really that surprising from them, because like I said, they've always been cutting edge. These digital workers have direct managers, work autonomously, and could in the future have access to email and communication platforms. JP Morgan Chase is also exploring increasingly autonomous AI tools with a version of AI assistants for employees and AI concierge for clients. Now, this gets into JP Morgan Chase. I think what they're doing is more what I was just talking about, and that is the augmentation of the abilities of your current workers, with autonomous AI tools, with a vision of AI assistance for employees and AI concierge for clients. I think they're seeing that from a more practical standpoint at the beginning right now where we're at, and saying, yeah, we can really use this and expand upon this to increase our efficiency, our productivity, all the things that we're doing inside, internally, and externally. But Bank of New York Mellon said it now employs dozens of artificial intelligence-powered digital employees that have company logins and work alongside its human staff. Similar to human employees, these digital workers have direct managers they report to and work autonomously in areas like coding and payment, instruction validation. With Chief Information Officer Leanne Russell, soon they'll have access to their own email accounts and may even be able to communicate with colleagues in other ways, like through Microsoft Teams, she said. This is the next level, Russell said. While it's still early for the technology, Russell said, I'm sure in 6 months' time, it will become very, very prevalent. What the bank, also known as BNY, calls digital workers, other banks may refer to as AI agents. And while the industry lacks a clear consensus on exact terminology, it's clear that the technology has a growing presence in financial services. Others aren't necessarily taking the same approach of granting their AI full logins, but many say they are shaping AI into applications that increasingly replicate the capabilities and workflows of human employees, taking on more and more tasks in areas like the software development of life cycle and research. Several, like JP Morgan Chase, say they are still figuring out the exact right access and management controls and system integrations and how human-like these tech systems will become. BNY said it took 3 months for its AI hub to spin up 2 digital employee personas, one designed to clean up vulnerabilities in code and one designed to validate payment instructions. Each persona now exists in a few dozen instances, and each instance is assigned to work narrowly within a particular team, Russell said. That way, no digital employee has broad access to information across the company, she added. We'll see. I mean, it's fascinating. Very fascinating, very interesting. This is a picture here of BNY Chief Information Officer Leanne Russell. it's yeah. Again, I'm highly fascinated by what BNY Mellon is doing here, and we'll have to keep. We will continue to see. We'll have to see what goes on there. So, okay. Let me take a sip here. All right, Microsoft. And this is probably one of the things I had the biggest issues with this week because so the article here says Microsoft to lay off about 9,000 workers. The latest round of layoffs come on top of the roughly 6,000 roles the company eliminated in May. What this article does not say is that they also applied to get another 3,000 HB1 visa people in. Obviously, again, replacing U.S. workers with cheap foreign labor. I think that should be a non-starter. I think somebody needs to step in here and basically say no, like no, dude, you're not no, you're not going to fire 9,000 U.S. workers and go and hire go hire another 3,100 HB1 visas. Like no, like that's just a hard no, a hard stop. And I hope somebody looks into this because I think it's ridiculous. I think it's ridiculous that Microsoft is doing this right now. Anyway, now what? But switching gears, so what is Mark Zuckerberg up to? Well, Mark Zuckerberg announces a new Meta Super Intelligence Labs unit. Alexander Wang will be the chief AI officer, and Nat Friedman to lead work on AI products. So Mark Zuckerberg created a super intelligence division in Meta led by Alexander Wang and Nat Friedman. The new Meta Super Intelligence Labs will combine FAIR, Llama models, AI products, and a new model development lab. Zuckerberg has hired 11 new employees from OpenAI, Google DeepMind, and Anthropic to boost Meta's AI development. Now, what I've reported on and what's here in this next article is that basically Elon Musk has this list. It's known as the list, and it's a secret file of AI geniuses. Only a select few researchers have the skills for the hottest area in tech. Mark Zuckerberg and his rivals want to hire them, even if it takes pay packages of $100 million. Incredible. Absolutely incredible. Mark Zuckerberg is compiling a list of top AI engineers, aiming to recruit them to Meta with lucrative offers. These AI researchers, often with PhDs from top schools, are highly sought after due to their specialized knowledge. Labs are taking security measures to protect AI breakthroughs as companies compete for talent with huge investments. So, Mark Zuckerberg is not sitting around on his laurels. He is hell-bent on winning certain aspects of the AI race here, especially with AI. He wants to compete against OpenAI with a lot of the coming AI products that are going to be coming out, this next generation of products, if you will. And he's making no qualms about it. He's making this list. He's checking it twice, and he's willing to pay people north of $100 million to come work for him. And he's got this whole new super intelligence lab unit set up. And he's going to try to give everybody else a run for their money here. Amazon, Google, Microsoft, OpenAI. I mean, all these guys, Anthropic, they better all pay attention because Mark Zuckerberg is basically signaling that, he's going to be plucking your best and brightest away from you, and he's opening the checkbook. He's opening the checkbook to get all the people that he wants in there. So very interesting. Now, what's happening on the China end here? So China is quickly eroding America's lead in the global AI race. So Chinese AI models are becoming more popular worldwide, testing American superiority. So Chinese AI firms challenge U.S. dominance, offering cheaper alternatives adopted globally by various sectors. U.S. restricts China's access to AI tech, while China invests heavily in its own AI supply chain. A divided AI landscape risks lost sales for the U.S. and hinders global cooperation on AI safety standards. So basically the race between the U.S. and China, the arms race now on AI, just continues to heat up, and we'll just keep an eye on that. So this article was interesting from a couple of areas. So Tesla is in disarray. Musk has already moved beyond caring about cars. So the electric vehicle maker has an aging lineup and slumping sales, but its CEO has shifted his focus to robo taxis and robots. So um, Tesla's vehicle sales fell 13.5% in the second quarter, continuing a sales slump amid rising competition and shifting consumer preferences. Musk is prioritizing autonomous vehicles and robots despite cars generating most of Tesla's revenue. Investors maintain a nearly $1 trillion valuation based on Musk's vision, even as analysts value the car business at a fraction of that. So, in other words, what's happening here with Tesla is a very fascinating thing. So Elon Musk is in basically a race against time here because Tesla, I think in his mind, because you're going to see that the tax cuts for EV vehicles is going to go away. EV vehicles are not getting this full on push from the U.S. government. The number, in other words, EV vehicles are may yet in the future become the dominant vehicle type, but that's not going to happen by again through the Biden administration. They were all hell bent on this 2030, basically having every vehicle be EV, get rid of all gas powered vehicles or whatever. Well, that's not coming. That's not going to be a reality. And Ford and GM are and Stellantis. These companies are all going to be continuing to make. They're going to continue to make gas powered cars for a long time. And they're going to have to go back into redeveloping gas-powered engines again. At the same time, EVs will become better. I think Tesla's EVs will continue to get better. They will continue to make improvements. But, market share, market dominance, I think all this is going to level out. And as other companies get better, and as other companies catch up to Tesla, as the electric vehicle becomes a little bit more commoditized, if you will, because basically, there will come a point where Tesla just won't be the dominant, market player in the EV space, or just, their cars just won't be as cutting edge as they were before. Elon Musk already sees that. So he's in the process of now transforming Tesla into a much different company. He wants to have the robo taxis become the dominant autonomous robo taxi out there, which may or may not happen. I don't know. We'll have to see. But he's also going full bore into AI and robots. Like that's where he wants to, the Grunk AI, he wants to make that the dominant AI. He's got the AI company that he's created. Obviously he's doing all the stuff with Neuralink. And obviously the umbrella over all this is Starlink, being able to connect all these devices and do all these things. But again, I think he sees the future of Tesla in a very different place, which is evident by what's going on here. But the problem that he faces, and the question is, can he pull this off? Because a lot of entrepreneurs, a lot of CEOs over the years have tried to pull this kind of thing off, where their main thing, like Tesla cars, Tesla vehicles, that's their main business, and that's what provides them all their profit right now. He wants to switch this to, robo taxis and AI and robot products, which again may be the future, and that may play out, and it may eventually turn into a major boom for Tesla down the road. But that pivot is a very tricky one, because if their sales continue to go down and if the product continues to plateau, that's really going to hurt their revenues going forward. And will they have the money to pump into all the R&D and all the development of all this new stuff, and can that actually start making Tesla a lot of money, a lot of profit, before all the revenue from Tesla cars, if it continues to erode, that's a very, very tricky balancing act. And like I said, there are, dozens, if not hundreds of examples of entrepreneurs and founders who have tried to pivot their companies away from something that was enormously successful or something that they were known for, into this whole new area. And a lot of times I would say 90% of the time, that transition usually doesn't go well. And it usually ends up, falling apart because the company's trying to do something totally different from what its original core business was. And so, and again, if there's somebody that could pull it off, I would say Elon could pull it off. I think this is a much bigger gamble than what people actually think. I think this is a very, very big gamble on Elon's part, this whole pivot. And then he's got all the political stuff going on. So I don't know where this goes. I personally think that Elon would do himself a big favor by just staying out of politics for a while. I think he would do himself and his companies a lot of good by just go fly under the radar for a little bit, take a year, step back, go back and just focus on these businesses, focus on these companies. He's talking about he wants to start this third political party and he wants to do all this stuff or whatever. Well, that may be so. That's not going to make him any fans. Okay. Do you think that's going to make him fans on the left or the right or neither? I'm going to say neither. He's going to create a lot of hardships for his companies, which I think are self-inflicted wounds that don't need to be done. And he's firing a whole bunch of people over there because obviously, he's saying, why are sales down? Why is this happening? Why is that happening? And obviously the answer is, well, because of you, Elon, because, you're out there in the political world and this is the price that is that your companies are paying the price for your politics right now. And again, I'm not beating Elon up on that. I'm not saying that's good, bad, and different. I'm just saying that is just a reality. It's a hardcore reality. And, he probably wants to fire people because they're not giving him the answers that he likes, but but it's just a very interesting thing. And then finally here, and I am really surprised that this has not happened yet. So Hollywood confronts AI copyright chaos in Washington in courts. Technology firms say using copyrighted material to train AI models is key to America's success. Creatives want their work protected. So Hollywood is pushing back on AI companies using copyrighted work without permission, fearing it would destroy the value of their work. The White House is creating an AI action plan that could influence how copyright rules are applied to training large language models. The fight between tech and creative companies is in Washington in courts with billions of dollars and the future of copyright law at stake. Absolutely. So now, we just saw Disney file a lawsuit. Basically, I am shocked that companies have not woken up yet to this reality of, all of your intellectual property is on the line, man. You run the risk of your intellectual property becoming worthless. And that is an enormous, for all these companies, any company that owns all this IP, the crazy amount of IP that Disney owns. And there's layers to this, right? Because, because we just talked about, like I just pointed out the AI race between China and the US, right? Well, look, I think in the US, these companies go in, they fight. There's going to be some kind of new rules around this, right? To protect, obviously, you have to protect people's copyrights, their patents, their intellectual property. At the same time, what gets restricted in the U.S. is not necessarily going to get restricted overseas or in China or whatever. Like China doesn't care. They're going to steal all this intellectual property and they're going to pump it into their AI and they're going to put it out. So again, is it kind of like cutting off your nose to spite your face in a certain sense? I don't know. I don't know how to answer that yet. Like I said, all I'm saying is I am shocked that this has not already happened. I'm shocked that Hollywood and Disney and a myriad of hundreds of other companies out there have not filed all kinds of lawsuits basically saying, yo, you're not taking my intellectual property to pump it into your AI. Like that's not happening. I'm just like, again, I'm shocked that has not already happened, but I think it's going to happen. I think it's going to continue to come out. And I think that's going to add another wrinkle to what all these companies are trying to do in the AI space. So again, just quickly, just to recap here, digital workers have arrived in banking. BNY Mellon and JP Morgan are working on all kinds of stuff. CEOs are basically being open about the fact that AI will wipe out jobs. Microsoft laying off a bunch of people to hire a bunch of H-1B workers. Mark Zuckerberg has developed this new superintelligence lab. He's opened his book. He's plundering all the AI geniuses all over the place right now, spending a ton of money. China and the U.S., this arms race on AI continues to heat up. Elon is in the midst of really trying to recreate and change Tesla. And obviously Hollywood and a lot of other companies are now going to start, the AI copyright lawsuits are going to start flying. And we shall see what happens with that. So, all right. So at this time, I'm basically going to wrap up. I'm going to do our story of the week and our quote of the week. So let me get my stuff up here. So we covered the G7. We covered the G20. We have covered a bunch of different things here over the last couple of weeks. We've covered the International Monetary Fund. So today we are going to cover the World Bank. So the World Bank is an international organization dedicated to providing financing, advice, and research to developing nations to aid their economic advancement. The bank predominantly acts as an organization that attempts to fight poverty by offering developmental assistance to middle and low-income countries. Currently, the World Bank has two stated goals that it aims to achieve by 2030. The first is to end extreme poverty by decreasing the number of people living on less than $1.90 a day to below 3% of the world population. The second is to increase overall prosperity by increasing income growth in the bottom 40% of every country in the world. Noble goals indeed. I hate to say I don't have a lot of faith they're going to get there, but hey, they're trying. So that is the World Bank, everybody. And obviously I'll bring more on that. I'm going to be covering hopefully some other things in the weeks and months ahead. I want to cover like the Bank of International Settlements. We're going to talk about the London Metal Exchange, the Federal Trade Commission. So we're going to talk about a lot of different these organizations, companies, regulators, different things around the world that all have amazing influence on what is our global economy and global financial markets. So, okay, now with that being said, let's do our quote of the week here. And obviously with Friday being the 4th of July, I wanted to do something a little more patriotic. So I got a quote here from John Adams. Again, one of my favorite quotes. So, I must study politics and war, that our sons may have the liberty to study mathematics and philosophy. Our sons ought to study mathematics and philosophy, geography, natural history, and native architecture, navigation, commerce, and agriculture in order to give their children a right to study painting, poetry, music, architecture, statuary, tapestry, and porcelain. And that is from John Adams. So if you understand that there, in other words, what he's saying is that I have to go to war and I have to fight here in order to give future generations the ability to study other things. Then hopefully they won't have to spend as much time in politics and war, that they will have the freedom, that I will make the sacrifice now, that they will have the freedom in future generations to study poetry and music and architecture and tapestry and porcelain. So very profound statement on the part of President John Adams. So with that, again, I will wrap up. I will say one last thing. I found this book on economics here, very interesting book. This is called How Economics Works. And what I love about this book, if you have a high school or a college student out there that is really having a hard time trying to understand economics, go pick up this book, because this book is broken into, it goes into the fundamental of economics. It goes into microeconomics, macroeconomics. It goes into economic schools of thought, like in other words, classical and neoclassical economics, Keynesian economics, post-Keynesian economics, Marxian economics, Schumpeterian economics, institutional economics, just to name a few. It gets into international trade. It gets into, and then the final section is on finance. And it does it in a very it has a visualized style to the book. If I could kind of show that there, you can kind of see it on all this, and everything is like this. It's all broken down in kind of like these 1-2 page explanations in a very visual style. Makes it very easy. You kind of see another thing here, makes it very easy to kind of understand this. It tries to simplify economics in a way that makes it very understandable for people. So again, that, and who is the, it's kind of weird. The author is not on here. Let me just see here if I can. Yeah, it basically just has like a project editor. So this is coming from Penguin Random House, project editor Daniel Brin. So, and yeah, so it's kind of interesting. So basically this is put out by a company called DK Publishing. But again, great book. Basically basically a book that is really, how economics works. And I apologize here, basically the concepts visually explained in this book. So again, how economics works, highly recommended. I basically got this for my kids who, are in high school right now, and basically so that they can hopefully study this and will help them with some of these economic and finance concepts. Hopefully better understand a little bit some of this in easier capacity. But with that being said, basically I will sign off. I thank everybody for kind of watching on this Sunday afternoon. I hope everybody has a great week out there. Next week, I will be back, normal time, BND BND Strategy Room live stream will be back on Saturday night, 8 o'clock. So I hope everybody will tune back in. And again, don't really have any travel plans or anything for the next month or two. So hopefully we'll be getting back into a rhythm of doing the regular live stream every Saturday night. And again, a lot of episodes planned, a lot of interviews, things coming out here in the next couple of months. So I hope everyone stays tuned. And I'll just wrap up by saying, if you like this live stream, if you like any of this episodes, please make sure to like, share, and subscribe, as that really helps the channel. I will say on a final note, if you are a Spotify listener, if you listen to the podcast on Spotify or Apple Podcast, please make sure to leave a review. If you really like what you're hearing and seeing, please make sure to leave a review, as that will really help us out. And remember, we are on YouTube, Rumble, and all major podcast platforms. So I hope everybody has an awesome week out there. Thank you again for listening, and I will see everyone again real soon. Thanks a lot.